Hello, Mark Sturdy here with highlights of 7 days ahead's weekly multi-asset technical strategies, 8th of February 2022. Let's look at the summary of our stances. And as regards the currencies, the broad point is that even though there's much greater volatility creeping in short term, in no case is the overall bull dollar case seriously threatened. So we remain bears of the euro, bears of the yen. A certain amount of uncertainty in the dollar sterling remains, but the exciting new situation we think of worth noting is this weakness of the sterling against the euro. Let's just look at that because that's the new one. Long established trading range here from 2016, and sterling had strengthened right to the top of this trading range and now has sharply fallen. Now this is the monthly chart, so it looks a bit like a monthly key reversal, but that's the close on the month that matters. But if we go to the week, we've got a weekly key reversal, higher high, lower low, closing on the lows, fallen back through this support. Given the wider context, we think this is an interesting and important move, suggesting more sterling weakness to come. If we go to the very short-term chart, we've got a day key reversal, higher high, lower low, closing on the low, and we think in short order we could come down and test this and maybe lower. So that's the new, quite strong stance we have: short sterling, long euro. Now, as regards the stocks, we're very much less clear in terms of our stances. Been great bearishness, we know, over the last few weeks, and then there's been a rally, a sharp rally. There is a suspicion of top formations possibly beginning to be created in the S&P 500 and the Nikkei, and relatively strong situations remain in the Euro Stoxx 50 and the FTSE 100. The FTSE, in fact, is a nice bull trend. The Euro Stoxx 50 is within a trading range, a well-established trading range, and the S&P 500 and the Nikkei 225, as I say, might be forming top formations. All in all, we are steering clear of taking a strong stance. The Euro Stoxx 50 and the FTSE are relatively strong, and these two are relatively weak. Turning then to the bonds, we remain big bulls of yields in the US Treasury note and in the gilt. Let's just look at those. Here we have moves in the US Treasury bond driving up through the prior high 177 in the monthly chart and driven by this bull continuation triangle in the weekly bar chart. And in terms of price terms, futures price, we have a continuation triangle here driving this on, well established. The market tried to rally back, met the resistance, went sideways, formed a triangle, is now broken down. So bearish for price, bullish for yields. Similarly, the gilt. I've rather redrawn this and reinterpreted this. This is a head and shoulders bottom, we think. Shoulder, head, shoulder. Some dithering around the neckline. Broken up. We think the minimum move is as far as 1.8 yield. We're down here at 1.4. Still some way to go. Here's the shorter term weekly chart. Driving the catalyst for the next move is driving up through the prior high 121.90. Here's the price chart, bearish. We dithered the prior low of 122.60 and is now broken on down. So we're bearish the US Treasury note, we're bearish of the gilts. The bund is by no means not bearish, bullish of yields, bearish price. It's actually gone rather far. It's rather overextended, so we're less bearish from these levels. There's the breakdown in prices. Perhaps, true, we should be turning to the commodities. Oil is looking very good. Now this is the line chart, not a bar chart, because there have been some odd closes in the bar chart which distort the picture. But if we use this closing line chart in the monthly, we see a bull triangle, bull falling wedge, completed some while ago, some volatility, but nonetheless driving better. Normally we'd interpret these falling wedges as suggesting move to the prior high of the wedge, which is somewhat higher, maybe 140, 130. But that's in the long term. Medium term, this is a bit detailed, but we have good support suggesting down here at 35, bounced off, finally bounced off, some volatility. And there's a good argument here for, so we have the 3 bounces off the 35 thing level. Is it a bull double bottom? 1, 2, not very tidy, not very convincing, you might say. If it is a bull double bottom, that calls it up to 125. If it is, instead of a bull double bottom, a head and shoulders reversal, and the reason we might want to doubt that is because of the slope on the neckline, because that's affected by the scale used. We think that has some integrity, actually. That suggests, so the double bottom suggests 125, and the H&S reversal suggests 130 or more, getting up to that prior high here, 145 or so. In short term, it's broken up above this. I don't think this is of great significance, this diagonal, but this prior high is obviously a catalyst for the next bull leg. Gold is not, we don't have a strong view on gold. We're not involved there, but it is worth pointing out that the uncertainty remains, big trading up and down here. There isn't any clear structure. Clearly there's support at 1707, 1, 2, 3 bounces off it. It is worth noting there is a weekly key reversal there, and there is a weekly key reversal here. I suggest that the trigger of suggesting the key reversal is intact and driving the market on down would be a break of this diagonal, which hasn't happened yet. This is an interesting parallel channel, one not alternating, and the market's dithering underneath it, so we're not taking a strong stance. Thanks very much.